From Deloitte Tax and Legal Japan, welcome to the Japan Perspective. This is a podcast where we speak to specialists from across Deloitte to discuss the latest business issues impacting foreign multinational companies in Japan. I'm today's host, Sho Nishi. Today, we will discuss some of the 2025 tax reform proposals. There are more proposals than we can cover in this episode, so we will focus on a few significant proposals that we think foreign multinationals should be aware of. It should be noted that these are proposals and have not been enacted into law yet. To help talk through some of these proposals, today's guest is Brian Douglas. He's a managing director and a part of Deloitte's inbound business tax team in Japan. He has experience in international tax in both Japan and the US. Thank you, Brian, for joining the podcast.
Thanks for having me.
To start, are there any common themes in the 2025 tax reform proposals that are relevant to foreign multinationals?
Well, in terms of common themes, I think in this inflationary environment, we see several provisions, at least on the individual tax side, where the government's looking to put more cash in the hands of the consumer by allowing greater exemptions and deductions on the individual tax return, and by making it easier for consumers to make better investments by revising some of Japan's investment systems, such as the national individual savings account system. Now, getting to impact on foreign multinationals, I won't say there's a common thread among all the provisions in the reform. There are several notable proposals here. One being there's a corporate tax rate increase, and the other notable one being Japan's continuation of implementing the OECD's global minimum tax rules, or the Pillar 2 rules. And in this time, Japan's going to introduce, or at least proposing to introduce, the qualified domestic minimum top-up tax, or the QDMTT, and the undertaxed profits rule, or the UTPR.
Okay, let me ask about the corporate tax rate. I normally hear of countries looking to reduce tax rates, so spur investment. So why is Japan, I will say, with the current corporate effective tax rate of 30 or 35%, increase in tax rate?
Yeah, well, with the Japan's not looking to spur investment with this particular provision. With the geopolitical tensions around the world and in the region, Japan's looking to strengthen its self-defense force, and it needs some revenue to do that. So that's really the driver behind Japan increasing the corporate tax rate. And the way Japan's going to do this is it's actually introducing a new tax called the Special Defense Corporate Tax that will come into play here for tax years beginning on or after April 1, 2026. And it's going to be a surtax of 4% on top of the corporate tax liability. So what that means for corporate taxpayers in Japan is that they'll see their effective tax rate jump by almost a full percentage point from April 1, 2026. Now, this shouldn't come as a total surprise to companies. The government actually suggested that it might do something like this back in the 2023 tax reform proposals. And it also indicated that it may increase the individual tax rate. But in the 2025 proposals, we see that the corporate tax rate increase coming through, but not the individual tax rate increase.
Okay. And I guess with any changes in tax rate, there will be implications on a company's deferred tax calculation. Is that correct?
Yeah, that's exactly right. So there'll be some tax accounting implications here once this rate is enacted, which we expect to be maybe in the end of March sometime. Companies will need to recalculate deferred tax assets and liabilities for any of those items that are going to reverse, on or after April 1, 2026. And while we're on the topic of tax accounting, there is another proposal in the provision that will have an impact, and that relates to operating leases. So when companies enter into a lease agreement for lease of equipment, for example, a company will pay certain lease payments throughout the year, et cetera. Now, historically, for accounting purposes, these lease payments could be expensed as long as the lease was considered an operating lease and not a finance lease. And then for tax purposes, tax would just follow the accounting rules and there would be a deduction for that lease payment. But in the fall last year, um, the accounting rules changed such that all lease arrangements will need to be reported as an asset on the books of the lessee and depreciated over time. However, the government would like to maintain the status quo for tax purposes by allowing a deduction for lease payments on operating leases. So what will end up happening here is companies will have a new book tax difference that they'll need to monitor from year to year. And these rules will kick in from April 1, 2027, but early adoption is possible.
I see. Okay, let's move on. You mentioned about Pillar 2 related to provisions including the introduction of the QDMTT and UTPR. Can you walk us through these proposals?
Sure. So let's start with the QDMTT. So assuming there's a Japanese subsidiary that's part of the multinational group that is subject to the Pillar 2 rules, then if that Japanese subsidiary has an effective tax rate of less than 15%, well, the QDMTT will allow Japan to additionally impose a tax on that subsidiary in order to top up its tax and ensure that the Japan entity is paying at least 15%. Now, we don't expect many Japanese companies to have an effective tax rate of 15%. As you mentioned earlier, current rates, corporate tax rates are 30 to 35%. So this would be a rare situation, but not impossible. Furthermore, even if companies' effective tax rate is not less than 15%, there are some calculations and reporting requirements that companies will need to deal with. Now, on the other hand, the UTPR could actually result in additional tax liability under the right circumstances. So the UTPR will allow Japan to impose a tax on a Japanese subsidiary where there's another entity within the multinational group in another jurisdiction that has an effective tax rate of less than 15%. But this rule, the UTPR rule, will only come into play where there are no other Pillar 2 provisions that are applying. So, for example, the ultimate parent entity has not implemented the income inclusion rule, and that other local jurisdiction has not implemented a QDMTT. Then in that case, Japan and any other jurisdiction that has a UTPR will be able to tax their own subsidiaries to ensure that the multinational group is paying at least 15% on its revenues, on its profits.
Understood. Then what about Japanese consumption tax? There was a big change in last year where Japan introduced platform taxation requiring large platform operators to collect and remit JCT when that platform operator allows foreign suppliers to supply digital services through the platform to collect and remit JCT.
Yeah, from a consumption tax perspective, there really wasn't much in the reform proposals this year other than some revisions around operating leases. Certainly no changes to the platform taxation, which is coming into effect here in Japan. But what was notable there is that there was some language that indicated that government is monitoring platform taxation rules and that changes could be coming here, maybe in next year's tax reform or the one after that. So I think the government's closely monitoring these rules along, in looking to align them with other best practices around the world. So we'll see what happens in the consumption tax space with respect to platform taxation.
Right. Let's see what's going to happen. Thanks again, Brian, and thank you very much to our listeners for tuning into this episode. If you want to learn more about the 2025 tax reform proposals, please check out our newsletter. A link will be in the description. Also, please join us for our webcast, where Brian and others will discuss the proposals in more depth on March 6th at 3 p.m. Japan time. A link to register will be posted in the description to this episode. In addition to that, please don't forget to fill out our survey and tell us what you think of this podcast. Last but not least, you can find other episodes of the Japan Perspective under our group name, Debriefs Asia Pacific, on LinkedIn, Apple Podcasts, YouTube, Facebook, and X. Have a great day, and we hope you're listening to our next episode.